Now it's time to look not at the characteristics of momentum indicators, but how we can monitor reversals in their trends. And we do this because when momentum trends change, so most of the time do prices. There are three principal methods to be considered. These are trend lines, price patterns, and moving averages. Occasionally it's possible to construct a trend line on the momentum indicator by connecting a series of peaks or troughs. An example for an uptrend reversal is shown in this diagram. When the line is violated, a trend reversal signal for the oscillator is generated. The conclusion and significance of the break should be based on the principles outlined in our basic building block section on trend lines. This type of momentum weakness should be regarded as an alert, and action should only be taken when confirmed by a break in the price trend itself, like this. In effect, the momentum trend break is reinforcing the price trend break and offers an additional piece of evidence that the trend has reversed. An example signaling a new uptrend is featured here. In many cases, the break in the price trend line will occur after the momentum trend by some time, but that does not generally cause the signal to lose its potency. As a general rule, it does appear that if both lines are violated more or less simultaneously, the strength and reliability of the signal is enhanced. Indeed, since momentum usually leads price, I'd say that when the price is the first one to trigger a signal, that's usually a sign of a fairly robust reversal in the overall trend. It should also be noted that momentum trendline breaks can be confirmed by any legitimate trend reversal technique that we could apply to prices, be it a moving average crossover, price pattern, or peak and trough progression reversal, and so forth. This chart has all of the elements. First, some positive divergences. Second, the last momentum low is just below zero. Third, it's possible to construct a nice downtrend line for the momentum series. Finally, the price also breaks out above a nice downtrend line and confirms the momentum pretty well simultaneously with its trendline break. Little wonder that an above-average rally follows. Here's a chart of the Silver Trust ETF during a strong 2011 rally. It was possible to construct this trend line for the 45-day rate of change. It was fairly long, and it had been touched or approached on several occasions, so it was a reasonably good line. The problem was that it was not possible to construct one for the price that, when violated, was close to the low of the move, and this was because the price had been advancing persistently through February. Not surprisingly, there wasn't much of a rally. Contrast that to this trend line for momentum, which was penetrated close to its low, and which had been touched on far more numerous occasions. Now look at the price, another good line that had been touched or approached about 5 times. It was violated close to the turning point and was followed by a huge advance. I've covered up the rest of the price action because I want to show you that a little bit later on. Momentum indicators also signal trend reversals by tracing out price patterns, so let's take a look at that aspect. Because of the shorter lead times normally associated with reversals of falling momentum, a breakout from an accumulation pattern, when accompanied by a reversal in the downtrend of the price itself, is usually a highly reliable indication that a worthwhile move has just begun. Here's an example of the oscillator forming a rectangle. Since the price needs to show a response, we see a confirmation trendline break a little later on. Note that the retracement move found resistance at the extended trendline. This example features a head and shoulders top in the oscillator. It too was later confirmed by a trendline break in the price. That trendline just happened to be the neckline of a head and shoulders top. In this case, the confirmation was delayed by some time, which raises the question of when a confirmation comes so late, it has nothing to do with the momentum reversal. Unfortunately, there's no hard and fast rules on this, but I'd say that if it looks like an oscillator has started another trend, ignore the signal. Generally speaking, on a daily chart, the confirmation loses credibility if it goes on for much above 4 to 6 weeks. It's important to use a little common sense in interpreting momentum patterns. This example shows a breakout from a reverse head and shoulders pattern that takes place as a result of an overbought condition. This is not to say that such signals will never be valid, but it stands to reason that a breakout from an extreme level is very unlikely to result in a sustainable price move, because an overbought reading tells us that the probabilities favor a move to the downside, not the upside. In this example, the price does confirm with a break above an inverse head and shoulders neckline, but it turns out to be a false breakout. This is typical of counter-cyclical moves, in this case a bullish breakout that develops under the context of a primary bear market. This is a chart of the silver ETF we looked at earlier. If I uncover some more of the action, you can see that the 45-day rate of change completed a small head and shoulders top, and this was confirmed by a break in the price. Now, I would have expected a larger price decline from such a pattern, but the event does underscore the principle that technical analysis is not very good at forecasting the characteristic of a new trend. Finally, we see an upward sloping head and shoulders and the rate of change that was again confirmed by the price and was followed by a nasty correction. Here's a 10-minute chart for Intel in August of 2011. The rate of change in this case has a 45-period span, or roughly 1 day's trading. On the left, we see a trendline break in the ROC being confirmed with a trendline penetration by the price, as well as the completion of a small head and shoulders base. Later on, both series complete ascending triangles, and this is followed by a reasonable intraday advance. Finally, the rate of change breaks out from a reverse head and shoulders, and the price completes a double bottom. That looks pretty good, so we should definitely book substantial profits from this setup, right? Well, if I uncover the rest of the action, you'll see that this was not the case. Given the evidence presented in this chart, there's no reason why the price should have gone down. The probabilities certainly favored it. Once again, say there was a 70% probability that the price would advance, there would still have been a 30% one that it wouldn't. That could have been for any reason, but the most likely one would lie in the fact that the more dominant trend, higher up than this one, was bearish. That's what I wrote after seeing this. So then I thought it might be a good idea to check this point out. So this is where we were on the 28th of July 2011. Here's the hourly chart for the same period. Remember, the previous chart featured 10-minute closes. As you can see, the sharp ROC rally on the 10-minute series translates to a mere blip on the hourly chart. Moreover, it was preceded by an important trendline violation in the price and a head and shoulders top in the hourly ROC. This momentum series also suffered a trendline violation. Remember, all this is happening just before our buy signal on the 10-minute chart. Finally, as the price was rallying, the rate of change was declining. Hardly a bullish sign. The moral of the story is always look up at the higher time frame than the one you're trading in order to gain some perspective. This chart of Comcast shows a series of negative divergences with the rate of change. Little wonder why we might not want to trust this tentative upside breakout from this ascending triangle formation. A final reason why not is that the breakout was taking place when the technical condition was overbought. Interpretation of momentum indexes, as described above, depends to a considerable extent on judgment. One method of reducing this subjectivity is to smooth the oscillator by using a moving average. Warnings of a probable trend reversal in the price being monitored are offered by momentum moving average crossovers as indicated here. But one of the problems associated with this approach is that the momentum indicator is often much more jagged than the price index that it's trying to measure. And this causes a generation of an unacceptable number of whipsaw or false signals. It's possible to filter out some of these whipsaws by using a change in direction of this smoothing to signal when the momentum reverses. This sell and this buy signal work quite well, and so do these. However, this sell signal comes right at the end of the decline, which means that this system should never be used mechanically, but that you should pick and choose the buy and sell signals in combination with what the price is doing. If it's moved significantly by the time the oscillator is reversed, it will be ignored, and so forth. Another alternative is to run a moving average through our smooth version, a moving average of a moving average, if you will. Momentum buy and sell alerts would then be generated when the shorter-term moving average crosses above or below its long-term counterpart. This interpretation of momentum is explained in greater detail in some of the subsequent modules, since momentum forms the basis of the trend deviation and MACD indicators. This is the same 45-day rate of change for the SPIDER consumer staples we saw earlier, but this time I've added a 30-day moving average, that's the blue line, and a 10-day smoothing of it, that's the red line. To make matters easier, I'll get rid of the raw data so we're left with the two moving averages. The idea is that when the blue 30-day moving average moves above its 10-day smoothing, we get a buy alert. The actual buy signal will come if the price breaks above a downtrend line, completes a price pattern, and so forth. In this case, nothing happens in this regard because we don't have enough history. The next crossover is a negative one and is supported by a trendline violation in the price. Not much happens on the downside because this is a contra-trend sell signal in a bull market. Then we get a couple of whipsaws where no harm is done, and this is followed by a buy signal, which stays in force for a while. The next sell signal in 2007 foreshadows a trendline break. This is one of those situations that really doesn't work out in that the line is violated. The momentum gives a sell signal, but the price works its way back above the trend line once more. Again, this is a sell signal in a bull market, and if something is going to fail, it's usually something that develops in a contra-trend way. However, as we move on, you can see that the 30-day moving average continues to make lower highs. So at this point, it's barely able to remain above zero. When the red trend line is violated, we certainly see an above-average move, as typically happens with this type of setup. Note also the two whipsaws that preceded this action, this one to the downside and this false break to the upside. Whenever you get a whipsaw, expect an above-average move in the opposite direction. In this case, not only did we get two whipsaws, but a momentum indicator that could barely move above zero at a time when the price was very close to its high. This was a classic bearish setup. Unfortunately, the sharp drop and rebound offered no indication of a price confirmation of a relatively timely oscillator reversal. That's not a real problem, because in this game, there's always another train leaving the station. In summary, 1. Momentum is a generic term embracing many different types of oscillator. 2. Momentum measures the rate at which prices rise or fall. It gives useful indications of latent strength or weakness in a price trend. This is because prices usually rise at their fastest pace well ahead of their peak and normally decline at their greatest speed before their ultimate low. 3. Since markets generally spend more time rising than falling, the lead characteristic of momentum indicators is normally greater during rallies than during reactions. 4. Oscillators reflect market sentiment and have different characters in primary bull and bear markets. 5. There are two basic methods of interpreting momentum: momentum characteristics and momentum trend reversals. 6. Momentum signals should always be used in conjunction with a trend reversal signal by the actual price.